Okay, welcome everyone. We'll start our week 3 and LO3. Today we'll go through LO3 learning outcome 3. As you know me, my name Anjum Sattar. Please, if you have any question, drop me email. I'll try my best to get back to you as soon as possible. Our other email admin@ukversity.co.uk. You can drop us email. Okay, so today lesson will go through the be able to prepare the financial reporting statement for different types of organization. Organization can be sole trader, partnership, limited company, and key indicative content. What we're supposed to be will go through the application of accounting concept, principle, valuation of non-current asset, depreciation, different method of depreciation. We'll discuss about how we can value our inventory, stock, either at cost or net realizable value, the value of the sale, and irrecoverable bad debts, and we'll look around ISAs and IFRS financial reporting standard and international accounting standard. That will be in our discussion, and key focus will be on these. Okay, scale 1 to 10, what you know about financial reporting? Okay, so how many types of financial statement we prepare in accounts? Always good to be reflect. Okay, so in accounts we prepare uh, 4 types of financial statement. First statement is called statement of comprehensive income. We call profit and loss or income statement. It shows income, expense. Yes, and second statement, statement of financial position, also known as balance sheet. It shows asset, liabilities, and capital. Third statement is a statement of cash flows. It shows inflows and outflows, operating, investing, and financing activities. Okay, then next we'll go through different types of ownership. Sole trader is a 1% business, partnership 2 to 20. Under the Partnership Act 1890 in the UK, we follow and we do activities accordingly. The third is the company, which we registered in the company house. We follow the Company Act 2006. That's the key which we'll do, and we prepare the accounts. So asset have 2 types, non-current asset, which is also known as a long-term asset, and that can be tangible, intangible, plant, machinery, property. These are tangible asset which you can see, you can touch. Asset mean anything you own which has the economics value is your asset. Goodwill is your reputation. Current asset, also known as the short-term asset or the liquid asset, most liquid you can convert into the cash. Short-term asset. So we can categorize asset into 2 and liability into 2 categories. Okay. So as I mentioned earlier, non-profit organization is the charities. It can be types of ownership. We can register in the Charity Commission, and we follow the Charity Act 2011, and we registered in the Charity House. Statement of financial position, statement of financial activities, annual reports of Charity Commission, and sometime income and expenditures account. We also submit, the Charity Commission can ask us. Okay, so liabilities, limited liability mean limited. It's mean you can't really somebody claim from your personal or private asset. So the company registered, we prepare account under IS1, International Accounting Standard 1. It is published by Accounting Standard Board, and where we'll shows and all our asset, liabilities, and the company have a limited liability. Nobody can claim from personal asset. Okay, like always, either you do companies or others, it have advantages and disadvantages. Nothing is perfect. So compliance with the national legislation, the company need to be follow the Company Act 2006. If you don't follow compliance with the national or international accounting standard, yes, funds can be from the retained profit, previous year profit. We can borrow money through short-term loans, overdraft, and we can use share capital, and we can issue the loans notes to raise the fund. Okay, these are a bit snapshot about the Company Act, which is 2006. We follow international accounting standard, international financial reporting standards. Always under IS-1, International Accounting Standard 1 is about you should prepare and present a financial statement. The information should be true and fair. What should be true and fair? That's the key message of the financial statement. Those need to be true and fair. Okay. Next, we looking asset have non-current assets, capital expenditures, IES 16, property, plant, equipment, state subsequent expenditures, and should only be capitalized in these circumstances. Yes. So IS 16 is about value of property and plant, which show the depreciation. Depreciation can be straight line method, one fixed depreciation every year. Diminishing balance method, always the carrying value of the asset, which is mean the asset minus accumulated depreciation, finding the carrying value, and we do the asset valuation. And expenditures can be two types: capital expenditures and the revenue. Capital is mean which increase the value of the asset. Like if you extend your house, that will increase the value of the house. That will be known as a capital expenditure. Revenue expenditures, which is day to day in and out expenditures, and these are known as a revenue expenditures, and those need to be managed daily basis, and those are short term, like cleaning, maintaining asset in the same position. Any money you spend, that will be known as capital revenue expenditure. Okay, the financial finance purchasing of the non-current asset, we need cash, we can borrow loans, we can hire purchase, finance lease. It can be operating lease. Operating is a short term, really. It's a short period of time, like a rent. It can be make contract, but you need to look around the contract duration. Part exchange, these are can be method of financing of non-current asset. Anybody, any question, guys? If you have, you can ask, please feel free. You can chat in the chat box. You can drop me email if you're listening. Okay, so then we have a non-current asset we have previously established we can capitalize in the statement of financial position, the point they are purchased. However, not at the end of the story. Accrual concept. What is accrual is also known as a matching concept. It means the each year's income and expenditures should be recorded in that year, not basis of the cash, because maybe you're selling goods 5 years credit, so you have a this year's sale, but the cash will come in 5 years. So we do accrual accounting concept. Yes, should be matched in the year's income and expenditure. Non-current asset purchase help guarantee income over a long term, but the cost of the asset should be matched in the period when the income is earned. Yes, when you paying it, you bought the asset, you can record it. That's not an asset, is expenditures. We can look around the depreciation every year that we can claim, or we can claim for the tax purposes. It's called capital allowance. That's, we need to look around each year under capital around for the tax rule purposes. Okay, next we are looking. Okay, various, like I mentioned, calculating depreciation. If you're using straight line, unit of production, or diminishing balance method, annual depreciation charge, so your cost minus residual value, which is means scrap value, the use of the life of asset. You can use 5 years, 6 years, 10 years, so you can divide, so we've been given here example. So asset is worth of 20,000, 6,500 is scrap value. Asset can be used 5 years, so divided by, so depreciation each year will be 2,700 pound. If the asset is being already used 3 years, so you can do accumulated 27 times 3, so that will be your accumulated depreciation, and you can calculate the following year carrying value of the asset. Okay, accumulated depreciation. Okay, residual, yes, useful economics life of the asset. Okay, if you're using the diminishing balance method, what you have to do, you have to minus the previous year depreciations. And then let's say we are using 20% depreciation per annum on the diminishing balance method. Yes. So 20,000 times 20% is the 4,000. So first year is the 4,000. So 20,000 minus 4,000. So is the carrying value of the asset. But if it's the second year, so you have 20 minus 4 is 16,000 and 20% of 16,000. Yes. So you do the depreciation and so on. So first year you will see the 4,000, 20,000 minus 4,000, then you do 20% will be 32. Yes, 16,000 times 22%, that will be 3,200. So the following year, your depreciation will be carry on reducing under the diminishing balance method. Yes, we call carrying value you have to find to calculate the asset. So this is your book value when you bought it minus your depreciation. This is the carrying value at the end, the start of the second year is the 16,000. So that's you do the depreciation. Then the unit of production. So you have to estimate how many units we can produce. Let's assume the machine costs you 10,000 and we can produce it 10,000 units. So if your machine is 10,000, you produce 1,000 units. So 1,000 divided by 10,000 times by what was the cost, so you can find it how much is depreciation need to be the year's charge proportion of the unit, the machine being used. Yes, so this is also method we can use for the depreciation calculation. Okay. Third, we looking to calculate record period, end of year adjustment, irrecoverable bad debts. Irrecoverable mean the bad debts, anything you can't recover. Yes, we can allowances the provision. We can create how many percent people not going to pay us, the depreciate these, the loans or the debt. So we're looking here, complete the trade receivable. We have to receive the 60,000 less irrecoverable, which we can't recover is a 600 if that was, and then 10%, and then we are looking if we have an allowance, so we also minus 3% if we created allowance on. So is the previous year which we 100% sure that we can't really written off 600, we can allowance it afterwards 3%. If it's a policy of the company, we can decide based on the previous experience how many percent people are not paying it. So that's we need to be well aware of. Yes. So we need to be bad debts. Bad debts mean the money we can't recover from the okay. Then allowances of the doubtful debts, you need to be allowances for the doubtful debts with record there, either create increase or decrease the allowance in the year that profit and loss will carry on making the adjustment. Maybe we estimate 3%, actually 2% people not paid us money and 1% people is so on. So we need to be make the adjustment accordingly. That's we need to be look around. Okay, like you will see here, we can prepare the T accounts. We can look around the doubtful debts, how much we have, how much we charge to income statement that debit in, and we can look around in the financial statement and we'll make the adjustment which we'll go through. Allowance for doubtful debts is a provision which we can shows, and we can make adjustment in the, because normally your trade receivable is the debit, when you provision you minus, so net will be your trade receivable will shows in the in is your financial position, which is balance sheet, and the charges will go in the statement of income statement. And we can make the adjustment if you have a provision less or more in the previous year actual expenses, the less and more happened. So you will see here, guys, so you will see the machine, how much was, we can make adjustment, and trade receivable, how much was, how much is allowance, how much is adjustment, and we can make in extended trial balance the adjustment. So we need to be make sure we'll carry on doing adjustment. That's is a crucial in the balance sheet. Third, we have prepared the financial statement with adjustment. So I'm giving you example here. So you have done the adjustment, you've been given the sale, purchase. So you need to be look around and which thing goes in the profit and loss, like the sale goes in the profit and loss on the credit side, and the purchase is opening inventory plus purchases minus closing inventory, the cost of sale if you do in gross profit. So you do the debit and credit in your profit and loss, the statement of financial position. You will see here that we done it, the vehicles and all others, we done the debit and credit in the balance sheet and we make the adjustment there, you will see we make their both accounts. So when you prepare that final accounts, your trial balance should be balanced as well, and the figures need to be, you will see the profit and loss we prepare. Yes, all the formulas we use, the based on your previous sales minus. So less, your expenses. And then we need to be look around the adjustments you're working, please always do. If you're preparing under IS1, we call revenue, otherwise we call sales, other turnover, these words will carry on using. And under IS1, the layout of the statement is it's a less, headings. That's the key, is a standardized like a distribution cost, admin cost, and all, So please guys, you go through these example and then to do merit analyze the component. So I copied the link for you in review the financial statement of Tesco and Morrison and look around their layout of balance sheet, income statement. And when we'll do assignment, I'll give you more examples. You will see here adjustment how been, yes, so statement of profit and loss, and we did the working on, and then statement of change in equity, statement of financial position, and then we have a e-learning, which if you want to, you can copy the link and you can go through. Okay, then I copied the link for you to do a quiz, check your understanding about accounting and adjustment entries, how we can in the statement, and that will help you. Okay, so that's really we need to, and thanks for attending today's session. And the next lesson will go to LO4 learning outcome 4. Thank you. Have a nice time. And if any question, drop me email or drop us email. Thank you. Bye-bye.